Hey guys, welcome back. So if you guys have been keeping up with the stock market, you'll know that everything has been selling off in the past few days. What I want to do in this episode is talk about volatility and how we can actually take advantage of the sell-off. So we can see that the Nasdaq is down over 5%, however, as of intraday trading, it was down over 6%. It's been a pretty sharp correction for a lot of stocks. However, if we look at this on a 1-year time chart, we can see how much the market is still up. It's still up over 44% in 1 year. So is this the beginning of a market crash? Well, my guess is as good as yours, but I'm not surprised at all that there's been some sort of correction in this market. So how should we move forward with this volatility? Well, first, I believe it's important to treat volatility as an opportunity. Now, although in the past year, it feels like stocks only go up, that's just not the case. Now, on this channel, I like looking for multi-bagger stocks and try to put these stocks on your radar for you guys to look into. However, I think it's also really important to study past history and to use it to better our investment strategy. Now, I'm a big fan of Cathie Wood at ARK Invest. However, my favorite investor that initially got me invested in the market and taught me most of what I know is Peter Lynch. Now, Peter Lynch is one of the most famous American investors and mutual fund managers, as he was the manager of the Magellan Fund at Fidelity Investments between 1997 and 1990. During his time, he averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index and making it the best performing mutual fund in the world. Let's take a listen of Peter Lynch on volatility and how we can take advantage of these opportunities.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
I believe that's one of the most important things when investing in a company is that you really understand and believe in the stock that you own. Now, when there's market corrections and stocks are down over 10%, it's important to have that conviction and belief in the stock so you don't panic sell at a loss. This is why doing the research and due diligence in a company before you get invested in it is crucial for your long-term success. So now I want to talk about some different tactics on how to navigate volatility. I'm sure there's been companies that you guys have wanted to invest in that are healthy businesses that have a good long-term future. This could be a great opportunity if you're not invested in the stock to build a position, or if you are invested in the stock to dollar cost average in. When you dollar cost average your investing, you're gradually reducing your overall cost basis in the share price. So when the price rebounds, your cost basis is always lower than the price. For example, if you invest $500 a month in a mutual fund selling for $25, your contribution buys 20 shares. If the share price drops to $20, your contribution buys 25 shares. Your account now has 45 shares with an average cost basis of $22. Now, what should most people do during volatility? Well, the answer is pretty simple. It's nothing. For long-term investors, the best thing to do when the stock market crashes is nothing. You need to resist any urge to sell stocks, as selling stocks in panic is probably one of the worst things you can do. Successful investing is about buying low and selling high, and when you sell it after a crash, you do just the opposite. Now, another strategy you can do is to rebalance your portfolio after things have calmed down. After a volatile period in the market, the value of your investments may change enough to shift your actual asset allocation away from your target. There's no rush, but big movements in the market are a good reminder to give your portfolio a checkup and consider making some moves to bring your portfolio back into balance. Now, in the few days, we've only seen a sell-off around 5%. However, what happens when we see a correction of over 10% and stocks continue to plummet? What should we do now? Well, Cathie Wood at ARK Invest actually recently did an interview talking about this bear case scenario and what she plans on doing. Let's hear what she has to say.
What we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names in which are creating losses now because, again, we've bought them, we've diversified and bought them more recently. Sell those names, creating losses, to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do during, and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to because they've lost a lot of their pipelines or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point in the coronavirus last year, it was as low as 33, I believe.
So what Cathie Wood just explained is tax loss harvesting, which is a strategy that can help investors minimize any taxes that they may owe on capital gains or their regular income. This in turn can help improve overall investment returns. As a strategy, tax loss harvesting involves selling an investment that has lost value, replacing it with a reasonably similar investment, then using the investment sold as a loss to offset any realized gains. Tax loss harvesting only applies to taxable investment accounts, and retirement accounts such as IRAs and 401ks accounts grow tax deferred, so are not subject to capital gain taxes. Now, the bottom line is that tax laws create the opportunity to engage in tax loss harvesting as an investment strategy. However, tax savings should never lessen or stand in your way of your investing goals. The best approach may just be to take a balanced strategy and frequently reevaluate your portfolio to make sure that all your investments are in line with your objectives. So simply put, Cathie Woods wants to use this tax loss harvesting strategy to sell more speculative stocks and rotate them into their higher conviction stocks that they believe the most out of their whole entire portfolio. So guys, my guess is as good as yours on whether or not the market is going to continue to dip. The market has just been going up and up over the past year, so it's natural for there to be sell-offs like this. This could be a really good opportunity to buy really healthy companies that are slightly at a discount and to really evaluate the strength and the overall balance of our portfolio in a really uncertain market environment. Thanks as always for sticking around. I hope you guys got a lot of value of this video breaking down volatility and how to take advantage of it. I believe it's really important to study the history of the stock market, as although history doesn't repeat itself, it often rhymes. And being one step ahead of the curve and having the right mindset to take advantage of these opportunities is really going to help strengthen us to be better investors. With that, guys, I'll see you in the next episode, and let's go get that bag.